my name is James Clark. I'm with Prime Lending, and Pam McCoy with Coldwell Banker has asked me to do a quick segment on where interest rates are and where they possibly could be headed in the next couple of weeks. The biggest thing you have to look for, what I call, is grease, grease, grease. And I don't mean the grease on your hamburgers. I mean the government. What you're seeing right now is Greece is currently in economic turmoil. They are at a spot where they cannot afford to pay the interest or the debt on what they have accumulated. This week, Greece, just so you know, is actually tied to the euro. The euro encompasses probably about 20 European economies. So those 20 European economies do not want to see Greece default on their debt because it will weaken the euro. With a weakened euro, money moves over to the US economy, and that's why you see interest rates at all-time lows because of the Greece debt problem. On Monday, those European economies came up with a plan to actually bail them out. When that plan came out on Monday, interest rates actually jumped probably from an eighth to a quarter point on Monday and Tuesday. Interest rates since then have actually went back down to where they were on Friday. The reason being is people started looking at what that plan encompassed. That plan actually encompassed people that held the private debt of Greece to take a cut on how much they are owed. They are being asked to take a 53.5% cut. What that means is if I own $100 worth of Greece's debt, they're asking me to accept $46.50. When people started analyzing that, they realized this plan might not go through. So again, you're still in the same situation with Greece, and that's why interest rates have actually went back down to where they currently were last week. So what to look for in the future? One, Greece. Positive news about the private investors accepting this deal will increase rates because money will move back to the euro. Negative news, well, money will keep coming over to the US economy, rates will start to drop. The second thing is to look for is the Fed came out this morning. They want to continue their aggressive monetary policy. What does that mean for you? It means they want to keep rates low. How do they do that? They do that by buying what's called mortgage-backed securities. By them entering into the markets, creating more buyers. More buyers means lower yields on those bonds, which means lower interest rates. So what you have to look out for that is when do they plan on purchasing these mortgage-backed securities and how much. The third thing to look out for, if none of the first two things happen at all next week, is on Friday will be the release of the economic employment data. Positive news about jobs, rates will go up. Negative news about jobs, rates will go down. So keep an eye on those three things. The biggest one next week that I'm foreseeing is going to be the economic report on Friday. So if you have any questions about where rates are headed, please feel free to give me a call. My phone number is 916-412-0909. Thank you.